Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Gregory Carpenter. Greg is the Managing Director of BTI Group M&A, short for Mergers and Acquisitions, which is a business brokerage firm, and it's located in Campbell, California, close to San Jose here in Silicon Valley. He's been a business sale intermediary since 1985. The current focus for his business is on the middle market, valued from $5 million to $50 million. He was on the board of directors for the California Association of Business Brokers for 9 years, and Greg is a frequent speaker about how to sell a business. He's an arbitrator for the California State Bar and the Santa Clara County Bar Association. Greg says he has a great home at Incline Village at Lake Tahoe that he doesn't get to use very much.
That's the fact.
Greg, thanks for joining me today.
Well, thanks for having me here today.
So today, Greg and I are going to talk about preparing to sell a business. And to give you a little context, anyway, of the timing, our recording date is March 8th. So off we go with our questions. Greg, what are some ways buyers and sellers use to determine a value or a sale price for a business?
The most common ways are usually multiples of earnings, although sometimes there aren't enough earnings, so it's assets. And then, of course, they're the venture kinds of companies. But most of the companies that we deal with as business sale intermediaries are either what we would call a Main Street business, and that's typically the small storefront or small service kind of business that an individual owns. And sales are typically a few $100,000 to a few million. Or middle market companies. Middle market companies are a bit larger, and they would have revenues anywhere from 5 to 50 million, and they're characterized by having functional departmentalization, a management team, and a hierarchical organization with a lot of different customers and a much wider geographical market. So in the small businesses, the multiples of earnings are pretty small. They're typically 2 to 3 times earnings. And
now,
the earnings,
when we say earnings, we're not talking about like gross receipts, right? We're talking about like net income?
We're talking about the net operating income plus everything the owner pays himself.
Okay.
And we also add back non-operating items like interest, if they have a loan, for example, or non-cash items like depreciation and amortization.
Okay.
As businesses get bigger, the multiple gets bigger, and I've always assumed that's really because the risk gets less. Also, there are fewer larger businesses. If you looked at the distribution of the number of businesses by size, the vast majority of them have sales under 2.5 million.
Right.
And as you get from 2.5 to 10 million, there's a lot fewer. And above 10 million to 100 million, hardly any. And then just a few very large businesses above 100 million sales.
Yeah, so we're talking like Fortune 500, and that's about it. Huh?
Exactly. So you can see that if you get big enough to be on the stock market, your business is probably a lot less risky than a small mom and pop retail store. Therefore, a 17 earnings multiple on the S&P 500 really can't compare to a 2 earnings multiple to a Main Street. The businesses aren't even in the same risk class.
Yeah, they're totally
so
different.
Generally, the most common way is to look at some sort of multiple of earnings.
Okay. So what important assets and liabilities typically aren't on a company's financial statements? A lot of people think, oh, you know, and particularly accountants, okay, maybe I should say this, they're very focused on those numbers that are on the financial statements, but a lot of times the most important numbers aren't there. So maybe you can talk about that for a few minutes.
In a lot of businesses, the capital equipment is actually on a lease of some sort. So it's not really going to show up on the balance sheet as it's owned by the company that's leasing it to the operating business. Other things are real estate. Generally, the real estate that houses the business, if it's owned, isn't usually owned by the corporation that's operating the business. It's usually owned personally by the shareholders. And just as often, we'll see things that are loaned to the business, especially, for example, in food service businesses. If you go into a family restaurant, the coffee makers are probably owned by the coffee distributor. The waffle irons are probably owned by the distributor of the waffle mix. Likewise, if you go into a convenience store, the glass front refrigerators that say Coke, well, guess who owns those? really, Coke, not
Yeah.
the owner of the business.
Yeah.
And then we'll also often find a lot of assets on the balance sheet that really aren't business assets.
Mm-hmm.
Like if an owner has a fairly large Main Street business and has lots of cash flow going on, there may be several cars on that business balance sheet that are really his kids' cars that they drive to high school or when they're off at college.
I don't want to know about that.
You don't want to know about those things, but I've seen it all.
Okay. So, but I think really some of the most important assets we haven't really talked about at all yet, and they're sort of intangible assets. And so, number one is the customer list. So, in other words, and some people have said, I can't remember who it was years ago, it might have been Andrew Carnegie, I don't know, but it doesn't really matter. They said, I can lose everything else, give me the customer list, and I can have everything back, in short order. And so that's important. And then the other is intellectual property, things like that. What are the concept and the other things of the business? Those things don't show, or trademarks. It takes a very small amount maybe to show, but there's a lot of expense that went in creating it, but it hasn't been capitalized or
That's
valued.
Right. That's right. And you won't see those things on the balance sheet. And when we sell a business, we have to go through a process called allocation of the purchase price.
Yes.
And this is required for not only for the buyer to establish his beginning balance sheet, but for the seller to establish the different classes of assets and how much gain each one had when he sold. Usually in a profitable business, the biggest asset on the buyer's balance sheet going forward is an item called goodwill. Mm-hmm. And that's something you're not going to see on the seller's balance sheet either, because that's really the amount that the buyer and the seller agree is the price less the value of the tangible assets he's getting. And that's a calculated number based on the price at which the business actually sold. So you're not going to see that either.
Yeah. So anyway, but if I was going to buy a business, one of the first questions I would ask is, where is your customer list? And there's a surprising number of businesses that would say, my what?
That's right. But frankly, as an item on the balance sheet or even as an item on the allocation of purchase price at the closing for the sale, it's not normal to assign a value to the customer list itself. It's just one of those elements of goodwill.
Yeah.
And it all really boils down to the expectation that the customers are going to keep doing business under the new ownership. And there's an expectation that the cash flow and sales will continue on at the same trajectory.
I had a situation that happened years ago. In fact, my daughter and my son-in-law bought a restaurant 10 years ago. Actually, it opened on Valentine's Day 10 years ago. And so when they closed the deal, the purchase, the previous owner called my daughter and said, I called all the customers who had reservations, and I told them that we're not going to be open for Valentine's Day. And my daughter said, give me the list. So she called all of those people, and they opened with a full house for their first day of business.
Good move on your daughter's part.
Yeah.
Oh my goodness, what was he thinking?
Yeah, crazy. So anyway, all right, let's move on. Now, I'm thinking about selling my business, and I've been operating along for some time, and now I'm thinking about selling it. Should I do anything different as far as how I'm operating it when I'm getting into this preparation for sale mode?
Depends. If you have made so much money that you really don't care what the price is, then no.
Okay.
But if you want to maximize the amount of price that you get, and also if you want to maximize the portion of that price that's paid in cash, there are a lot of things that you can do that will increase not only the price, but the marketability of the business.
So what are some of those things that you should do?
Well, let's talk about Main Street first.
Okay.
The biggest problem in Main Street, and as a CPA, you just don't want to hear this, is that a lot of the sales somehow never make it into the cash register.
Uh-oh, don't tell me that.
I know, you don't want to know that.
That's really upsetting.
The first bit of advice I give small business owners who are planning to sell sometime in the future is start reporting all your sales. A lot of people think that, gee, I'll report all the credit cards, but anything that's cash, I don't know about that. Well, if your business is going to sell for 2 to 3 times your earnings, for every dollar that you don't report, you're taking maybe $3 off the purchase price of your business. So the first comment I always get back when I tell a small business owner this is, but think of all those extra taxes I'll have to pay.
Yeah.
Now they develop this mindset where those are not the normal taxes they're supposed to pay. They're so used to not paying them that in their mind, those become extra taxes. And I point out to them that still, if they're getting $3 back for every dollar of income they add to the bottom line, even though maybe they had to give 35 or 40 cents of those dollars in tax, they're still $2.50 ahead at the end.
Right.
So the most important thing for really small mom and pop Main Street business owners is start reporting all your sales.
Yeah.
Then the next thing is to clean up your accounting and bookkeeping. You want those records to be auditable. And here's why. Imagine that you're going to go buy a business.
Yes.
What's your biggest fear?
Well,
the books are cooked, right?
Yeah.
Okay. So you make an offer for a business, you bring your accountant in, and the accountant starts checking, and guess what? Nothing makes any sense. There are gross errors all over the place in the books and records.
Yeah.
Are you going to buy that business? No way. So the next thing is make sure that all your books and records are auditable, that every bank statement has been reconciled and checked off and balanced so that it will check out when the buyer's accountant comes through, because he will. And if they don't find a lot of errors, you've got credibility. The more errors they find, the more suspect not only your books, but everything you've told them about the business will be suspect, and you'll lose that sale. That's the big marketability item. Are your books auditable? So start reporting, get your books and records auditable. Then look around for risk factors, some that are manageable. Big risk factor in a lot of small and even medium-sized businesses is what we call customer concentration. We have a business listed for sale right now, and 79% of its sales are to one customer. That is pretty scary.
Yeah, it is.
And while there may be buyers out there who will buy that, the terms for that business sale are going to be very different than one that has 20 customers each with 5% of sales. If you lose one of those customers, you've only lost 5% of sales. If you lose this customer, you're out of business. You're gone. So someone will pay a small amount of cash up front and then give a note to the seller that depends on keeping the sales from that big customer coming in over several years. And it'll have a mechanism defined in it so that that note will be diminished if the sales from that big customer are diminished. So looking for manageable risk factors like sales concentration. The biggest thing we see in small businesses is that there's really no organization. Everybody reports directly to the owner, and there really are no significant business systems. Everything is in the owner's head, and without him, there really isn't a business.
Yes.
So to make the business more valuable and more marketable, they should really sit down with their CPA and talk about business systems, how to get it organized, and start training people to do the things that the owner does. I like to call the most marketable and valuable small business model the Wizard of Oz model.
Who's the man behind the curtain?
Exactly. In the typical high-risk small business, the customers only know the owner. They're not doing business with XYZ company. They're doing business with Joe over here.
Yes.
But in the Wizard of Oz business model, nobody even knows who the owner is. They're doing business with XYZ company. There are customer service people. The people may be even the ones who are doing the production work, but they've been trained to deal with the customers. The owner, although he may talk to customers, he doesn't even tell them he's the owner. He might be the customer service manager, the sales manager, the general manager. He should never admit even that he's the owner. And then when there's a new general manager in place, no problem. It's just an employee change, right? But if the owner is the only one that performs all the key functions in the business, like the only one who talks to customers, the only one who sets the prices or does bidding, or worse yet, the only one who does the highly skilled production work in the company, that company's not easy to sell and maybe can't even be sold at all. The owner needs to replace those critical functions with employees. and make himself the Wizard of Oz.
Mhm.
He needs to be orchestrating the resources of that business, not being the production engine, not being the star salesperson.
Okay.
That's the really most common problem besides inadequate books and records and unreported income.